Welcome back to the deep dive. So last time we were here, we really got into the weeds on fractional ownership, this, brilliant idea that tokenization lets an everyday investor own a tiny slice of something huge, like a skyscraper or an office building.
Mm-hmm. And we were talking very local. The whole focus was on finding new efficiencies right in your own backyard.
Exactly. But today we're basically taking that map, folding it up, and tossing it right in the shredder.
We really are. We're shifting from local efficiency to, I think, true global access. And our mission for you, for the listeners sitting there with us today, is to really get your head around the mechanics and the challenges of buying fractional ownership of property globally.
That's the key word, globally. We are diving deep into cross-border tokenized real estate. And just think about the promise here for a second.
It's huge.
It's the idea that you as an individual can buy a fractional share of, a luxury condo in Singapore.
Or a massive logistics hub in Dubai.
A historic office tower in London, all with the click of a button from wherever you happen to be, Alabama, Auckland, it doesn't matter.
And that promise is it's massive. We're talking about diversification on a scale that was unimaginable for retail investors a decade ago. And of course, unprecedented liquidity. But, and this is a big but.
There's always a but.
There's always a but. That promise is, it's forged in this crucible of really complex jurisdictional challenges. You have unpredictable tax rules and all the operational friction that just naturally happens when you try to bridge a physical, heavily regulated, centuries-old asset class.
Right.
With a digital, instantaneous, decentralized ledger. It's not a simple plug-and-play situation.
No, not at all. So over the next 30 or 40 minutes, we're going to break all of that down. We're going to look at the mechanics, how a token actually becomes a tower. We'll navigate the global regulatory map.
Which is a maze.
It is a maze. We'll pinpoint the exact friction points that can just kill your returns, and then we'll give you a mandatory due diligence checklist. What you absolutely need to know before you even think about taking that first global plunge.
This is really where that simple idea of owning a piece of the world gets profoundly complicated.
And therefore profoundly interesting. Okay, so let's unpack this paradigm shift, because it really is one. For the entire history of property investment, real estate has always been fundamentally local.
Inherently local, yeah.
If you wanted to invest in a major city, you had to physically go there. Or at the very least, you had to build a deep, expensive network of people on the ground.
Right. You invest where you know the market dynamics. You understand the local zoning laws, you know the players.
Right.
Where you can, literally go and touch the asset.
Touch the bricks.
Exactly. And that very localization creates these immense operational barriers to entry for anyone outside that circle.
Mm-hmm.
I mean, think about it. If you, sitting in the US, wanted to buy a piece of an office park in, say, Frankfurt, traditionally you'd need German legal counsel, which isn't cheap. You'd need complex cross-border financing. You'd have to get your head around German accounting standards, and you'd probably need to fly there, or at the very least rely on some very trusted local fiduciaries.
The friction, the cost is just immense.
It's so high that historically only, huge institutional funds or maybe some ultra high net worth individuals could ever justify the expense and the time. It just wasn't for regular people.
But tokenization, in theory, just bypasses that entire bureaucratic superstructure.
It completely cuts through it. By digitizing that ownership share and putting on an immutable ledger, the blockchain, it just overcomes those geographical limits. It fundamentally transforms who can access these markets almost overnight.
So if geography was the old barrier, what's the first big opportunity that this new model unlocks?
Well, the first and most obvious one is genuine global diversification. And I want to stress that this isn't just about making your portfolio look pretty on a spreadsheet.
No, this is about risk.
This is about crucial risk mitigation. The core concept is having access to global markets right at your fingertips. Yeah. So if your entire real estate portfolio was previously concentrated in, a single coastal U.S. city.
Like Miami or San Francisco.
Right. Then its performance was completely tied to that one region's economic fate. It was subject to its local political whims, its specific interest rate environment. That is a massive, massive concentration risk.
And with tokenization, you can spread that risk.
Correct. The benefit here is profound. You're spreading your investment across multiple countries, multiple economies that are all operating on different economic cycles. You get to balance your exposure.
What do you mean by different cycles?
Well, think about it like this. The commercial market in London might be booming, just as the residential market in Singapore is starting to cool off, and vice versa. Tokenization allows you to smooth out that volatility by balancing your exposure across these, disparate global cycles. It insulates you from the kinds of localized shocks that can absolutely devastate a concentrated portfolio.
Okay, let me push back on that for a second. A critical question, I think.
Go for it.
Doesn't globalization mean that the big systemic crises, a global pandemic, a coordinated central bank rate hike, a worldwide supply chain shock, doesn't that stuff tend to hit all markets at the same time anyway? Is this diversification just geographic, or is it actual economic protection?
That is a fantastic and critical question. And you're right, a major event like a pandemic or a war often creates a synchronized downturn in, say, the stock market.
Everything goes down.
Everything goes down. But property markets, they respond differently. They're stickier. Things like rental demand and capitalization rates are still heavily influenced by local economic policy, localized immigration trends, and very specific tax laws.
So the local factors still matter a lot.
They matter immensely. Tokenized real estate lets you diversify not just by country, but by asset type within different regulatory environments. For example, you could balance an investment in U.S. multifamily residential, which reacts really quickly to interest rates, with exposure to, say, long-term industrial leases in the UAE, which might be driven more by long-term strategic government investments.
Yeah.
It's that blending of distinct risk profiles across different economic models that provides the true hedge. It's more nuanced than just putting pins on a map.
That makes a lot more sense. It's about finding uncorrelated market drivers. A source material used that one striking example that really stuck with me. The ability to invest in a property in Singapore while sitting in Alabama.
It's a perfect illustration.
It just perfectly encapsulates how dramatically this technology can cut through those geographical boundaries. It unlocks a level of global portfolio management for the individual that it wasn't possible before.
It really democratizes the ability to achieve the kind of global capital allocation that, was previously only achievable by the world's largest pension funds.
Right.
And now with fractional ownership, that risk spreading benefit can trickle down. The entry points might be just a few hundred or a few $1,000s instead of needing a multi-million-dollar institutional commitment.
Okay, so that's opportunity number one, diversification. What's the second massive opportunity that you see fundamentally changing real estate investment?
Enhanced liquidity.
The big one.
This is the big one, and it cannot be overstated. Traditional property markets are, they're notoriously sluggish.
Glacial, even.
Glacial is a good word. Selling a $50 million building, even when you have a buyer lined up, involves transaction times that are measured in weeks or months.
Sometimes over a year.
Sometimes over a year, absolutely.
Yeah.
You have these long closing periods, physical document transfers, title insurance reviews, incredibly complex due diligence. It's just an inherently slow-moving asset class.
We're talking about processes that, best case, routinely take 60 to 90 days, minimum.
Exactly. But tokenized assets, because the ownership share is represented digitally on a blockchain, can be traded 24/7. This enables instantaneous, or at least near instantaneous, trading capabilities that are they're physically impossible in the traditional world.
So it's the difference between, waiting for your lawyer to sign off on an escrow agreement and executing a trade on a digital secondary market in a matter of minutes.
That's the leap we're talking about.
But again, let me play devil's advocate here. Let's introduce some critical thinking. If these assets suddenly trade 24/7, doesn't that expose what has traditionally been a very stable asset class to immediate, maybe even violent volatility?
How so?
Well, volatility driven by events in completely different time zones. A political scandal in Asia could cause the price of a London-based token to plummet overnight, even if the underlying physical building hasn't changed one bit.
That is absolutely the trade-off. You're spot on. Tokenization introduces market speed, and speed always implies a heightened sensitivity to new information.
Okay.
The stability that was inherent in traditional real estate came in part from its illiquidity. It took a long time for bad news to actually get processed and affect the price.
Right. The market was slow to react.
Exactly. Now, the token market is efficient, which means information, good or bad, is priced in immediately. And this means investors have to shift their mindset. You're no longer just a passive owner collecting rent. You become an active participant in a trading market that literally never sleeps.
So the risk is higher.
The short-term price risk is higher, yes. But the ability to exit a position instantly is also your protective mechanism. You're not locked in for months while the market turns against you.
And in a cross-border context, the implication of that 247 trading across time zones, that seems truly transformational.
Oh, it creates continuous market access. If you have an asset in Tokyo, which operates on Japan Standard Time, and you're an investor in New York, you can still access that market when all the Tokyo banks and offices are closed.
Because the token exchange is always on.
The token exchange operates continuously. It completely removes the time zone barrier and creates this unified global trading environment for this asset class. Liquidity finally can flow across borders and around the clock.
Okay, so to sum this section up, the paradigm shift is profound. We're moving from this hyper-local, illiquid, and frankly exclusive investment structure to one that is globally diversified, 247 tradable, and potentially accessible to anyone who can meet the necessary compliance hurdles. That's the promise. That's what keeps the capital flowing into the space.
Okay, so understanding the why, the diversification, the liquidity, that's the easy part. Now we have to tackle the how.
The nuts and bolts.
The nuts and bolts. And this involves a really rigorous and often very complex legal and technical process. It's all designed to bridge that gap between the physical building and the digital token in a way that, respects global law.
Right. Before the tower can meet the token, you need a solid legal foundation. And that brings us to this crucial middleman, the special purpose vehicle, or SPV.
Step one. The legal foundation.
Exactly.
So let's say a developer is building a new luxury retail center in central London. The very first thing they do is set up a dedicated legal entity, the SPV.
A separate company.
A completely separate company. And this SPV is legally structured to do one thing and one thing only: hold the singular asset, which is the property's title. The SPV is the designated legal owner of the actual brick and mortar building.
So the SPV is like a legal armor plate.
That's a great way to put it.
It isolates that specific asset from all the developer's other business dealings, which could be messy. So if the developer goes bankrupt, building a different project somewhere else.
The London Retail Center, held safely within its SPV, is shielded from those creditors, is protected. As an investor, you're not buying a piece of the developer's company, you're buying a fractional ownership stake in the SPV, which in turn owns the property.
That distinction feels paramount.
It's paramount for both regulatory compliance and for investor safety. The SPV creates this clean, transparent legal wrapper that you can then securitize. But let's go a little deeper here into something called jurisdictional arbitrage, because this is where it gets really interesting and complex.
Okay, jurisdictional arbitrage, break that down.
So the physical asset, our retail center, is in London. But the SPV itself might be domiciled or legally registered in a completely different, financially favorable jurisdiction.
Like where?
Common choices are places like Delaware in the US, or the Cayman Islands, or Switzerland.
Ah, so what you're suggesting is that the token issuer is using the SPV's legal home to potentially gain tax advantages or maybe benefit from clearer, more crypto-friendly securities laws completely separate from where the actual building is.
Precisely. If, for example, Cayman Islands law provides a more straightforward path for issuing security tokens, or it has favorable tax treatment on capital gains, the issuer may choose that as their domicile.
So for the investor, this means you now have 3 different legal layers you have to think about.
At least 3. You've got the asset's physical location, which is London. You have the SPV's domicile, let's say the Caymans, and you have your own residence, wherever you are in the world. The SPV structure is what enables this kind of deliberate, calculated regulatory maneuvering.
Okay, so once that legal structure is locked in and the title is secured by the SPV, we can move to step 2, actually issuing the token.
Right. Token issuance and ownership representation. The SPV now issues tokens on a chosen blockchain. And we need to be really specific here. Most people hear blockchain and they think of Bitcoin or, basic utility tokens.
Right, like an ERC-20.
Exactly. But real estate tokenization relies on something much more robust. Security token offering standards, or STOs. These often use specialized protocols like ERC-1400 on the Ethereum network, or similar security-focused standards on other enterprise-grade chains.
Why are those specific standards so crucial? Why can't you just use a standard ERC-20 token? It seems easier.
It would be easier, but it would be non-compliant and incredibly risky. ERC-20 tokens are simple utility tokens. They're like digital coupons. They don't have any built-in regulatory controls.
And security tokens do.
Security tokens, which are governed by protocols like ERC-1400, are designed for what we call programmable compliance.
Programmable compliance, what does that mean in practice?
It means the token itself can enforce legal requirements. For instance, The smart contract can be written to prevent the token from being transferred to a digital wallet address that hasn't successfully passed KYC and AML checks.
Know your customer and anti-money laundering.
Correct. Or the contract could enforce transfer restrictions that limit sales only to accredited investors for a specified lockup period after the initial offering. The rules are baked right into the asset.
So the compliance isn't just a checkbox you tick when you sign up. It's not just at the point of sale. It's embedded directly into the DNA of the digital asset itself.
That's it. So the blockchain, in this case, isn't anonymous at all. It's an immutable but fully compliant ledger.
And each of these compliant tokens represents a fraction of ownership in the property.
Specifically via the compliant SPV. Investors anywhere in the world can then purchase these tokens, and the blockchain records and verifies their fractional stake. It's essentially a decentralized registry governed by centralized, hard-coded rules.
Okay, now let's define what you've called the single most critical operational component in this whole chain. The thing that bridges the physical and digital worlds.
Custody and proof of asset.
Right.
This is the moment where trust is either cemented or it's completely destroyed. When you buy a traditional property, the physical deed is the ultimate tangible proof of ownership.
Sure. It's in a safe somewhere.
In tokenization, we need an independent, trusted third party to hold that sacred document, and that's the custodian.
So who are these custodians? Are they tech companies, law firms?
Typically, they're highly regulated financial institutions. Think banks or specialized trust companies that operate under very specific jurisdictional rules. Their one and only job here is to hold the physical deed or the legal title documents for the SPV. They are the independent third-party auditor.
And their role is to ensure that the tokens being sold are genuinely backed by a real asset.
And that the SPV's legal integrity remains intact. They are the anchor to reality.
This sounds critical, but it also sounds like it introduces a significant geopolitical risk, especially when we're talking about cross-border investments.
It absolutely does. That's a great point. If the physical asset is in a jurisdiction with, let's say, high political instability, or if it's subject to nationalization risks.
Where the government could just seize the property.
Exactly. Then the custodian arrangement needs to be robust enough to withstand those kinds of shocks. So as an investor, you have to ask, where is the custodian located? What jurisdiction are they regulated under? If the asset is seized by a government, what legal recourse does the custodian have to protect the SPV's assets on behalf of the token holders?
So the strength of the custodian's regulatory status and the political stability of the country they operate in directly impacts the risk profile of the token.
100%. The token is the digital representation, but the custodian is the physical proof. They're the insurance policy that guarantees the digital representation is worth something tangible, even when facing sovereign risk.
So you have to verify the integrity and the regulatory status of that custodian.
You must. If that physical link breaks, or if the custodian is unregulated or vulnerable, the trust in the entire tokenized asset just collapses instantly.
Okay, so we've got the legal structure, we've got the compliant token, we've got the custodian holding the deed. Now, finally, we get to deliver on that promise of liquidity.
Through the creation of secondary markets.
Right.
Once the initial token offering is complete and the funds are raised, the tokens are then listed on a compliant secondary market. This is often a regulated digital securities exchange. And this platform is what allows for the 2047 trading of tokens among the investors. This is the mechanism that finally delivers on that core promise of liquidity we talked about at the start.
This is where that continuous market access comes to life, letting a global pool of investors transfer ownership instantly, without the property itself ever needing that month-long traditional paper-based closing process.
All right, so now we enter the jurisdictional mice. And this really is the great counterweight to all the technological speed we've been talking about.
Right. We've established that the asset is global, but the rules are hyper-local.
And often conflicting. That's the source of the complexity. For a single token representing a single property, you have this dual, sometimes even triple, regulatory exposure.
Okay, break that down. What are the layers?
First, you have the laws governing the physical asset's location. So UK property law for our London building. Second, you have the laws governing where the SPV is domiciled, our Cayman Islands example, which determines the security law framework. And third, you have the laws governing where you, the investor, reside. You have to understand how all three of these jurisdictions interact.
And a mistake in any one of them could be catastrophic.
It could be. So let's look at 4 crucial global case studies to see how different this can be, starting with the U.S.
Okay. The United States. It's got the largest capital markets in the world, so it kind of sets the tone. But its approach seems to be characterized by fitting this new technology into very old, very stringent securities law boxes.
That is the key friction point. The U.S. Securities and Exchange Commission, the SEC, primarily applies what's called the Howey test to determine if a digital asset is an investment contract and therefore a security.
And the Howey test is from, what, the 1940s?
From a Supreme Court case in 1946, yes. And since tokenized real estate almost always involves an investment of money with an expectation of profits derived from the efforts of others like the SPV manager or the developer, it nearly always qualifies as a security under that test.
And that classification, classifying it as a security, that immediately limits the investor pool, right? Which kind of goes against the whole promise of democratization.
It absolutely does. Because to avoid the incredibly onerous and expensive process of a full public registration, like an IPO, these offerings are typically structured as private placements. And that means access is often limited to accredited investors.
So let's define that for our listeners. What does it mean to be an accredited investor in the U.S.?
Generally, it means you need a net worth of over $1 million, and that excludes the value of your primary residence. Or you need an annual income exceeding $200,000 for the past 2 years, or $300,000 if you're filing jointly with a spouse.
So in the U.S., the technology might break down the geographical wall, but the securities law just puts up a velvet rope restricting entry to a specific financial elite.
That's a perfect analogy. Exactly. Now, let's pivot and look at the European Union. Their approach is characterized by something completely different: proactive, region-wide harmonization.
And that harmonization is a huge deal because historically, selling a tokenized asset from, say, France to an investor in Germany would mean navigating 2 completely separate and probably contradictory regulatory systems.
A nightmare. The EU is tackling this head-on with a new framework called the Markets in Crypto Assets Regulation, or MiCA.
MiCA, we're hearing that a lot.
And you'll hear it more. MiCA aims to create a single, unified regulatory passport for digital assets that works across all 27 member states.
So how would it classify our tokenized real estate?
Under MiCA, most tokenized properties would likely fall under the definition of asset reference tokens, or RTs, since their value is tied to an underlying off-chain asset in the building.
And what are the practical implications of being an RT under MiCA? Is it strict?
It's very strict, but it's very clear. Issuers of RTs face comprehensive requirements designed to protect investors and maintain market stability. This includes things like high capital reserve requirements, mandatory, clear, non-misleading disclosure documents, and really rigorous governance standards for the SPV and the issuer.
So it raises the operational costs for the platform.
It does. But in return, it gives investors a high degree of regulatory certainty and confidence. If an issuance is compliant in Ireland, it can be seamlessly marketed to investors in Spain or Italy or Poland without having to start from scratch.
And that predictability, that's what institutional capital wants. They want clear rules before they deploy massive funds into this asset class.
Exactly. Okay, now let's move east. We find places that are prioritizing speed and innovation, like Singapore.
Singapore has always been a classic pro-innovation hub. They're known for clear rules and a big emphasis on financial technology.
And they took a very pragmatic path here. The Monetary Authority of Singapore, the MAS, they moved quickly to provide clear, tailored guidance. They recognized security tokens as capital markets products, but they established very clear pathways for compliance.
So less ambiguity.
Far less. They offer favorable tax incentives and a stable legal environment, which just minimizes uncertainty for everyone. And that has made Singapore an extremely attractive hub for issuers looking to launch sophisticated, compliant tokenization projects that are aimed at global buyers. Their whole focus is on using regulatory clarity to gain a first-mover advantage.
Okay, and for our final case study, let's talk about Dubai and the UAE. They seem to be aggressively using regulation as a tool to attract global capital.
Their strategy is all about rapid development through targeted, controlled experimentation. And they often facilitate this through what are called tokenization sandboxes.
Regulatory sandboxes. We've mentioned that concept before. Let's really explain what a regulator is doing inside this controlled environment. What are they testing when it comes to a tower-to-token transaction?
They're stress testing the whole model. For instance, they might be testing the efficiency of integrating KYC and AML checks for a large global user base from dozens of countries. Or They might be defining acceptable thresholds for non-accredited investor participation for assets below a certain valuation, something the U.S. is still fiercely debating.
So they're testing the boundaries.
They're testing boundaries in a safe way. Crucially, they test the robustness of the settlement mechanism. How quickly and safely can the fiat currency move to and from the token holders? How does that impact market stability? It's this iterative, learning-based approach that's designed to rapidly integrate new financial models, but with minimal systemic risk.
So we have this global patchwork quilt of regulation. It's cautious and legacy-based in the U.S. It's unified and harmonizing in the EU. And then you have these aggressive pro-innovation sandboxes in places like Singapore and Dubai.
And that diversity is precisely why your due diligence has to be triple-layered. You have to consider the security regulations of the SPV's domicile, the property law, the asset's location, and the tax and investment laws of your own residence. Failure to align those three can lead to serious legal complications, or at the very least, severely diminished returns.
All right, that promise of global access is exciting, but the moment that token crosses a border, you run headfirst into a wall of, well, reality. Currency conversion, tax laws, jurisdictional nightmares.
The operational friction points. This is where the rubber meets the road, and it's where returns can get eroded if you're not careful.
Let's start with challenge number 1, currency and settlement.
Right. So even if the token itself trades instantaneously on a blockchain, the underlying value of that token is tied to a specific fiat currency. It's yen for a building in Tokyo, dirham for Dubai, sterling for London. And this introduces an inherent financial friction that the blockchain by itself does not solve.
And this is more than just standard foreign exchange risk, right? Though that is definitely a huge factor.
Oh, absolutely. FX risk is the primary volatility risk here. If you, as an investor, purchase a London-based token using your US dollars, you are now exposed to the day-to-day volatility of the Great British Pound versus the US dollar exchange rate.
And that has nothing to do with the performance of the actual building.
Nothing at all. If the pound weakens against the dollar, your return when you convert it back to dollars is diminished. That can happen even if the building's rental income is strong and its valuation is rising. It's a completely separate layer of risk.
But you mentioned a deeper friction. It lies in how the money actually moves. The tokens are often bought or sold using stablecoins or other crypto. So how does the actual fiat settlement work for things like rental distributions?
And this is where the lag comes in. While the token trade itself is 24/7, the actual rental distributions, the cash flow you're getting as an owner, that has to originate from a physical bank account held by the SPV. And that account is denominated in the local currency. So getting those funds off-ramped from crypto, converted back into your home fiat currency, and then transferring them internationally, that process still faces delays based on traditional international payment protocols like SWIFT, which operate on traditional banking hours.
So the instantaneous promise of the blockchain gets bottlenecked by the old world banking system.
Exactly. And that can introduce settlement lag and even counterparty risk at those conversion points.
Okay, challenge 2. This is what I think is often the silent killer of returns for cross-border investors: taxation and withholding.
Oh, this is where simplicity ends and complex financial planning begins. It's a minefield. As a fractional owner of an SPV in a foreign country, you are very likely facing tax obligations in 2, sometimes even 3 jurisdictions.
So first, the country where the asset is located is going to want their cut.
Right. The source country will tax the rental income generated by the property. Then your home country, where you reside, is going to tax your worldwide income, which includes the income from that foreign property.
Yeah. And the most immediate pain point for the investor is probably the foreign tax withholding.
It is. The SPV is often legally obligated to act as a tax collection agent for that foreign government. They have to withhold tax, and it could be 15%, 20%, sometimes more on the rental distributions before they send the remainder to you, the international token holder.
So your cash yield is immediately lowered.
Your gross rental income gets a haircut from the foreign government before the money even leaves the asset's country. Then your home country wants to tax the remainder of what you received.
So how do investors avoid being taxed twice on the exact same stream of income?
This is where you have to navigate incredibly complex tax treaties. Many countries, including the US, have what are called double taxation avoidance treaties. For US investors, the primary mechanism is the foreign tax credit, or FTC.
And what does that do?
It allows you, the investor, to claim a credit on your US tax return for the taxes you've already paid to the foreign government. But, and this is a big but, Understanding the specific rules for calculating that credit and applying it correctly to passively generated income from a tokenized asset that requires specialized and often high-cost tax advice. It is not straightforward.
And I imagine there's an even deeper complexity when it comes to capital gains, right? When you sell the token, how do you even determine your tax basis?
You've hit on a huge problem.
Yeah.
How do you determine your original purchase price for capital gains purposes? If you bought your token on a secondary market from a totally anonymous seller in a different currency at a specific moment in time, tracking that precise tax basis can be incredibly difficult.
Especially if local laws require currency conversion at the moment of purchase for the cost basis, not the moment of sale.
Exactly. The very thing that makes tokenization attractive, the 24/7 global trading, creates a logistical tax nightmare that very few retail investors are prepared to handle on their own.
Okay, the third major friction point. This one is rooted in just basic trust. Valuation integrity. How do you, as an investor, ensure that the token's price, listed on that 247 secondary market, accurately reflects the actual constantly changing value of the physical property, the off-chain reality?
This is critical. Since the token is a derivative of a physical asset, its valuation requires continuous, verifiable input from the real world. Investors should be looking for 3 specific technological and governance solutions that mitigate the risk of the token trading, arbitrarily, completely separate from the building's true value.
And the first one has to remain the foundation, right? Independent professional judgment.
Independent appraisals. This is absolutely non-negotiable. There must be regular, unbiased assessments of the physical asset's value, conducted by certified third-party professionals on a scheduled basis. Quarterly is good, semi-annually at a minimum. This appraisal provides the objective financial baseline.
So if the token's market valuation deviates significantly from that appraised value, that's a huge red flag.
A massive red flag. The second solution is purely crypto-native, and it's fascinating. Oracles. Oracles are basically decentralized data feeds. They're often operated by companies like Chainlink or similar services, and their job is to continuously supply trusted external market information directly to the blockchain's smart contract.
And this isn't just the appraisal value.
No, it's much more dynamic.
Yeah.
It can include localized market indices, real-time rental payment data, current occupancy rates, even recent changes in property tax laws.
So the appraiser determines the baseline value, but the oracle is the delivery mechanism that keeps the digital asset honest by constantly feeding it real-world data directly into the smart contract.
And that data feed is critical because it helps govern the third solution, which is clear redemption mechanics.
Okay, what are those?
This is the transparent process baked right into the smart contract's code that defines how a token can eventually be exchanged back for its share of the underlying value. This would happen upon the eventual sale or refinancing of the physical property. It provides a critical floor price for the token.
Ah, so that's the ultimate safety net.
It is. If the tokens, for some reason, start trading far below the net appraised asset value, maybe due to a temporary market panic, these mechanics can offer a legal pathway for token holders to potentially trigger a vote to liquidate the underlying asset and return that intrinsic value to the owners.
I see. So the overarching takeaway from all this friction is that the investor has to demand total transparency and audited processes?
Absolutely. The success of cross-border tokenization rests entirely on verifiable trust. And that means the platform has to be able to prove the link between the highly liquid digital asset and the highly regulated physical asset through continuous auditable data flows.
Okay, so we've painted a picture of immense opportunity, but also, significant complexity and a lot of friction. So before you, our listener, commit a single dollar to a cross-border tokenized real estate project, we want to run through your mandatory due diligence checklist.
This is the information you absolutely must verify before you invest. Let's start with the absolute foundation. Who legally owns the asset?
Checklist item number 1. Legal title and SPV structure.
You need to verify the entire legal ownership chain step by step. This means confirming that the SPV is a legitimately registered entity, either in the asset's jurisdiction or that chosen favorable domicile.
And that it actually owns the building.
And that it holds a clear, unencumbered legal title to the physical property. Demand to see copies of the title documentation. If an issuer is trying to tokenize a property they only intend to buy, or one that has existing liens and debts against it, that is a giant red flag.
The documentation should be crystal clear.
It has to clearly define the relationship between you, the token holder, the SPV, and the physical asset. No ambiguity.
Okay, next up on the list, the integrity of that crucial physical to digital bridge.
Checklist item number 2, custodian identity and proof of custody. You must know who holds the deed, and you have to confirm their regulatory standing.
So is this custodian a major regulated financial institution like a bank or a trust company?
And in what jurisdiction are they operating? Is it a reputable one? Furthermore, you need to demand documentation that proves the specific custody arrangement for your asset. This ensures that the crucial legal link between your token and the property is held by a highly regulated, neutral third party. That's what minimizes the risk of fraud or even geopolitical seizure.
All right. The third point on the checklist is one that's often overlooked until it's April and tax season is looming.
Checklist item 3, tax treatment and withholding. I can't stress this enough. You must seek professional tax advice specific to your country of residence.
This is not a DIY situation.
Not at all. You need a thorough, documented understanding of the tax implications for both the distributions, the rental income, and any capital gains from selling the token. What specific tax rate is the foreign government required to withhold on distributions sent to international investors?
And does your home country have a tax treaty with the assets country?
And if so, how exactly do you claim that foreign tax credit to avoid double taxation? You cannot accurately model your expected net returns without having concrete answers to these questions.
Okay, our fourth item addresses the core promise of this whole market liquidity, which, as we've established, can sometimes be an illusion.
Checklist item 4, liquidity history and market maker commitments. That promise of 247 tradability is completely meaningless if there's no one willing to buy your token when you need to sell it.
So you need to check the order book.
Assess the token's trading history. Has the secondary market been active and deep? But more critically, you need to look for commitments from professional market makers.
And what do they do?
These are entities that commit their own capital to simultaneously placing buy and sell orders for the token. They do it to ensure there's always depth in the order book. Without committed market makers, your investment might become completely illiquid the moment market sentiment turns sour. This is what separates a genuinely tradable asset from just a theoretical investment.
And finally, ownership means having rights. How do investors make sure they actually have a voice in the asset's future?
Checklist item 5, review governance. Token holders are fractional owners, and ownership should imply specific, verifiable rights. You need to read the governance documents very closely.
What should you look for?
You need to understand your voting rights. Can you vote on major maintenance expenditures or a potential sale of the building or a refinancing event that could impact the asset's value? You must know the specific hard-coded rules for distributions. How often are payouts calculated and what triggers them?
And what happens if things go wrong?
Critically, are there established, transparent processes for dispute resolution? Does that include the ability to recall or replace a poorly performing SPV manager? You need to know the rules of the game before you play.
So this checklist is basically the institutional standard of due diligence, but it's been packaged for the retail token investor.
It is the absolute minimum requirement. If any of these items, the verified legal title, the regulated custodian, the clear tax regime, the demonstrable liquidity mechanism, or the transparent governance structure, if any of that is vague or unverifiable or just unclear, the investor has to pause before committing funds.
Because in cross-border tokenization,
clarity equates directly to reduced risk. Hashtag outcheck, outro, host, speaker, and expert speaker.
Hey.
Yeah, so let's recalibrate our final understanding here. Cross-border tokenized real estate, at the end of the day, is defined by 3 powerful, undeniable benefits.
You've got the massive geographic diversification,
the unparalleled liquidity speed,
and of course, the democratic access to high-value global markets that were previously just restricted to institutions.
This really is the democratization of global property investment. It allows you to own that slice of a Singapore condo or a London tower without ever having to set foot outside your own country or deal with all that traditional legal friction.
It's an incredible promise.
It is. However, this opportunity is equally defined by these unavoidable challenges that technology just cannot magically dissolve.
Right. These are the persistent regulatory and operational frictions that we just detailed. The jurisdictional maze, the complex dual taxation issues, the currency risks.
And that constant existential need to prove the valuation integrity against the physical reality of the asset. The technology makes the token transfer instantaneous, yes, but the real world still imposes legal and financial boundaries that you have to respect.
So our final thought, our call to action for you, the listener, is clear. Stay meticulously informed. When you're evaluating these global platforms, use the safety checklist we provided as your absolute legal filter.
Don't be seduced by the simplicity of the transaction interface.
Exactly. Always respect the complexity of the underlying assets, the legal structures, and the foreign tax regulations. Global diversification should be a calculated step in your overall financial journey. It should not be a leap of faith.
And to leave you with a provocative thought to mull over as you finish this deep dive. Now that you understand the mechanics, the friction, and the opportunities of buying property anywhere on the map from the US to the UAE, the central question really shifts from, can I invest globally, to something more personal.
Which is?
Which skyline would you invest in first, and which jurisdiction provides the regulatory safety net that you trust the most?
We've armed you with the analytical tools to dissect those jurisdictions. Now you get to decide on the geography and the governance. That's all for this deep dive. We'll talk to you next time.
1, 2, 3.